Hilltop Wealth Advisors economic and market update for the fourth quarter of 2022. I'm Brittany Brinkerhoff, here today with Rusty Erickson, and it has continued to be a wild ride of a year. So Rusty, why don't you give us a quick recap of what's happened so far in 2022?
Yeah, really glad to be here. And the third quarter really has been a continuation of a lot of the themes that we've talked about previously this year. The third quarter, we continue to see market volatility, and unfortunately, year to date, we've seen the S&P 500 decline about 18%. Now, we have come off the lows that we saw in September, but still seeing volatility for the third quarter. And then also the bond market has continued to be volatile. So the Bloomberg US Aggregate Bond Index has declined about 15% year to date. And if you look at this slide by JP Morgan, it shows the last 46 years of the returns of this bond index, which is primarily US government debt and high quality corporate. So position that people typically use to reduce volatility in their accounts and provide some more stability. But as you can see, this year has really been a year unlike any other where we've seen so much volatility in bonds. And really that's a story of inflation and interest rates, right? As inflation and interest rates go up, bond prices typically go down. And with inflation continuing to be such a big story here in the US, that's had an impact on almost every asset class. Now, outside of the US, we continue to see a lot of the same things that we've talked about before as well. Economic challenges within Europe, particularly around energy, and that certainly relates to the Russian invasion of Ukraine. And then within emerging markets, China continues to slow down, for example, and their zero COVID policy has certainly not helped their growth rate at all. So a lot of the things that we've talked about before have continued into this third quarter and continue to create some market volatility and concerns about recession, both here in the US and outside of the US.
Yeah, exactly. And a lot of those items are things that we're going to be tracking and watching for months to come. So looking forward, we do think there are two big themes that will continue globally. The first is tightening of monetary policy as an effort to combat inflation. And the second is recession risk as a result of that tighter monetary policy. In the US specifically, we are thinking it's more and more likely that we might find ourselves in a recession within the next year or so. But we do think it would be a more mild recession, especially compared to the more recent recessions we've seen in US history. And a lot of that is driven by strength in the labor market. The unemployment rate has remained very low. And as you can see on this slide, on the left of this slide by JP Morgan, there are still almost 2 job openings per unemployed person right now. That being said, we would expect that corporations will slowly start to lower their earnings outlooks and slow down their pace of hiring, which in effect will start to normalize the labor market. We think we might see a slight increase in the unemployment rate, but also just a decrease in the total number of job openings available. Another thing that we've been watching are the midterm elections, which are right around the corner, and the housing market, which has slowed significantly in the past few months, really driven by the higher mortgage rates right now. We don't expect to see a crash in the housing market, though, like we did in the Great Financial Crisis, for a number of reasons, one of which being that there is a quarter of the amount of inventory of homes, but also that mortgage underwriting standards are just a lot higher nowadays. So that is good. In terms of inflation, like Rusty mentioned, it has been very elevated, but we think over the next year, we'll start to see that come down, although it will likely remain above the Fed's 2% target for some time. Real quick, outside the US, Europe is definitely in a tough situation. They are dealing with, as a whole, high inflation, rising interest rates, and they're also much closer to the Russia-Ukraine conflict and are much more vulnerable to energy shocks. And then China, just like Rusty mentioned, has also been seeing slow growth, and they're likely to continue to see that slower growth, especially for as long as we see this zero COVID policy. So as a whole, there are a lot of items that might cause significant market volatility. So Rusty, why don't you talk a bit about how Hilltop is positioning for these risks?
Yeah, absolutely. And I think for us at Hilltop, our thinking is really along 2 lines. One is, where do we see opportunity today? And then where are there places where maybe we can add some more stability to the portfolio, given some of the economic concerns that you were highlighting there going forward that we're tracking. So on the opportunity side, right now, we do see more opportunity here in the US than outside of the US. So we are going to be shifting some of our international investments to the US. We just think the US has more tools in the toolbox to deal with some of the economic headwinds, and we think that the recovery will probably happen here in the US before it happens outside of the US. So wanting to change some of those investments and make a little bit of a shift more towards the US in our allocation. And then along the lines of adding stability, we are looking to add a healthcare position to the portfolio. Now, this position would be broadly invested in healthcare, so things like pharmaceuticals and medical devices, hospitals. Certainly, we'll have some biotech and other things in it, but what we see with healthcare is an opportunity to add a little bit more stability, as healthcare tends to be a little bit more recession-proof, tends to do well during periods of heightened volatility. So we think that'll be a nice complement to the portfolio there. So those things are along the on the investment side of things. As far as the planning side of things, we are looking to implement strategies that we feel like are opportunistic now as well. So for example, completing Roth conversions for clients where it makes sense, positions that have declined in value, maybe going ahead and paying taxes on those, converting them to the Roth. And then when that recovery happens down the road, have that recovery happen in an account where the growth is potentially tax-free. And then also continuing to implement tax loss harvesting like we've been doing throughout the year. So tax loss harvesting is when a position has declined in value. What we do is we sell it in order to realize that loss for tax purposes. We take the proceeds and invest it in a very similar investment so that we maintain the allocation, but there's a tax loss that can be used to offset other gains and potentially reduce a little bit of income as well. So a way to kind of make some lemonade out of the lemons of the market volatility that we've seen. But I think overall, we're encouraging clients to continue to refer back to their long-term financial plan and remain diversified as well.
Yeah, I think that's exactly it. Just keeping that long-term mindset is so key, especially during periods of market volatility like we've been seeing. Well, thank you, Rusty, and thank you all so much for watching. We hope you enjoyed this and learned something. And if you're not working with Hilltop yet, know that we'd love to talk with you, and you can find more about us on our website and the Hilltop Views blog. Thank you.